You've seen the shows, right? The sledgehammers flying, the incredible kitchen reveals, and of course, that big profit check at the very end. But what they don't show you is the #1 reason most beginners actually lose money flipping houses. And here's a hint. It has nothing to do with paint colors or countertops. It's about one thing: the math. So today, we're going to break down the simple calculation that separates a successful flip from a total financial disaster.
If you've ever binged one of those house flipping shows, you know the formula. They find a wreck, there's some drama, a stunning transformation, and then bam, a giant check showing how much money they made. It looks so exciting, so fast, and honestly, pretty easy. But here's the thing they never really show you. A ton of first-time flippers end up losing money. And it's not because they picked the wrong tile. It's because they got the numbers wrong from the very beginning.
All right, so first up, let's peel back the curtain and separate the TV fantasy from the financial reality. Because while knocking down a wall makes for great television, the real work, the work that actually makes you money, happens way before that.
So, just to make sure we're all on the same page, what exactly is house flipping? Well, at its core, it's pretty simple. It's the process of buying a property, fixing it up, what investors call rehabbing it, and then selling it as quickly as you can for a profit.
The TV shows, they just love focusing on the fun stuff, like picking out fancy countertops and arguing over backsplashes. But the truth is, a successful investor has already done about 90% of the really critical work before they even sign the papers to buy the house. Their most important tool isn't a power drill or a sledgehammer. It's a spreadsheet.
And that leads us perfectly into the next big idea, which is really the single most important rule in all of house flipping. Getting this right isn't just some clever strategy. It's a total mindset shift that will protect you from some really painful losses.
This right here, this is the whole game. Your profit isn't some happy surprise you discover at the end of the project. Nope, it's something you create, something you lock in, the very moment your offer gets accepted. Why? Because you bought the property at the right price.
Think about it like this. You could install the most stunning, high-end kitchen imaginable, but even that can't save you from the mistake of overpaying for the house in the first place. If the numbers don't work from day one, you're basically just renovating your way into a financial hole. That purchase price, it really does decide everything.
Okay, so that's the big concept. But how do you actually figure out what that right price is? Well, luckily, there's a really straightforward formula that all the smart investors use. It's what keeps them safe and guides every single offer they make.
And it all boils down to these 4 simple steps. First, you figure out what the house is going to be worth when you're done. Then, you subtract what it's going to cost to get it to that point. And then, this is the crucial part, you subtract the profit you want to make. Whatever's left over, that's it. That is the absolute most you should pay.
So let's break down that very first step. It's called the after repair value, or ARV for short, and it is the foundation of your entire calculation. So how do you find it? Well, you do what appraisers do, which is called the sales comparison approach. All that means is you look at the recent sales prices of very similar already renovated homes right there in the same neighborhood. These are your comps, and they tell you exactly what the market is willing to pay.
Theory is great, but seeing it with actual numbers makes it so much clearer. So let's just walk through a quick example so you can see exactly how this formula works in the real world.
All right, let's say you've done your homework. You've looked at all the comps, and you've determined that once this house is all fixed up and beautiful, it's going to sell for about $300,000. That's our starting point, our ARV.
Okay, so we're starting with that $300,000 ARV. Now, for step 2, we got to figure out our costs. Let's imagine you walk through the house with a good contractor, and together you figure out that the whole rehab, new kitchen, bathrooms, floors, paint, the whole shebang is going to cost around $50,000.
Now, for what might be the most important part of this whole equation, you have to pay yourself. You must subtract the profit you want to make before you ever make an offer. For all the risk and all the work, let's say you want to walk away with a minimum profit of $30,000. So we pull that out next.
And there you have it. When you take the $300,000 ARV, subtract the $50,000 for repairs, and then subtract your $30,000 profit, you're left with $220,000. This is your magic number. This is your maximum offer price. If you offer even a single dollar more than this, you're either going to have to cut corners on the renovation, or you're taking that money directly out of your own profit.
Okay, so you've got the formula, you've got your number, but you're not totally out of the woods yet. We need to talk about the hidden costs. Those sneaky little expenses that can just quietly eat away at your profit margin if you're not paying attention. And, the biggest ones are all tied to one thing: time.
These are what I call the classic profit killers. Maybe you underestimate the repairs. You open up a wall and find a huge surprise. Or you get emotional in a bidding war and just ignore the math. Or you hire a slow, unreliable contractor, and the project just drags on and on. But one of the most common and overlooked mistakes is completely forgetting about holding costs.
Think of holding costs as the silent assassins of your flip. These are things like your loan payments, property taxes, insurance, even basic utilities. They just tick away every single day, whether you're working on the house or not. A project that drags on for 6 months instead of 3 could easily cost you thousands and thousands of extra dollars, and that comes directly out of your profit. Speed is everything.
So finally, let's just zoom out for a second and put flipping into perspective. It's a fantastic strategy, but it's just one of many ways to invest in real estate. And honestly, it's not for everyone. You really have to ask yourself, what is my ultimate financial goal here?
Here's a quick side-by-side. Flipping is all about generating a chunk of cash quickly through a sale. That's called a capital gain. On the other hand, long-term investing, like the buy, rehab, and rent model, is all about building wealth slowly over time. You get monthly cash flow from your tenants, and you benefit from the property hopefully going up in value. You could say one is a sprint, and the other is a marathon. So the big question for you is, what's your goal? Are you looking for that quick lump sum profit from a flip? Or are you playing the long game, trying to build a portfolio that generates income for years to come? There is no one right answer, but understanding the simple math we talked about today, well, that's the critical first step, no matter which path you decide to take.